All right, let's talk about a company that's sitting right at the epicenter of one of the biggest economic stories on the planet, India's massive wealth explosion. The company is 361. So, is this the stock to bet on to ride that incredible wave? Or are there some hidden risks we need to be aware of? Let's dive in. So, this is the company we're talking about, 361. You might remember them as IFL Wealth. They are one of India's biggest non-bank wealth management firms, and their entire business model, their whole mission, is built around one thing: managing the money of India's absolute richest people. Okay, so a wealth boom sounds great, right? But how big are we really talking here? What does that even mean in actual numbers? Well, the scale of this market is, honestly, it's pretty staggering. And get this, 50 lakh crores? Nope, that's not a typo. We're talking trillions of dollars. That's the estimated size of the assets managed by the entire Indian wealth management industry. And it's not slowing down. It's expected to grow at something like 15 to 20% every single year for the next decade. But here's the crazy part. Even with those insane numbers, this market is nowhere near saturated. If you look at something like mutual fund penetration, India is still way, way below the global average. You know what that gap means? It means there is a huge, huge runway for growth as more and more of that wealth gets professionally managed. All right, so we've got this massive, growing market with just incredible potential. Now let's zoom in on our key player, 361, and figure out how they're positioning themselves to grab a piece of this pie. And they're not just a one-trick pony. I mean, yeah, their core wealth management business is the biggest slice, for sure, but they also have solid revenue coming from capital markets, asset management, and even lending. And you gotta see, this isn't just about having a few different income streams. It's a really smart, strategic model designed to capture value from their clients in a bunch of different ways. And who are their clients? Well, they're laser focused on what they call high net worth individuals, or HNIs. In their world, that means someone with over 25 crores. That's about 3 million US dollars just in assets they can invest. So yeah, this is a super exclusive, high-touch service. It's not for your average Joe. And they didn't get this big just by themselves. Nope. They've been playing chess, not checkers. They have a long history of making really smart, strategic acquisitions, gobbling up smaller wealth managers, buying the capital markets division from a giant like L&T, and most recently, bringing the India business of the global behemoth UBS into their fold. This is active market consolidation. So all these moves have paid off, big time. They are now a top 3 player in their space, commanding a really significant chunk of the market and managing a mind-boggling amount of money for their clients. Okay, so with all that in mind, you can probably see why investors are excited, right? It's pretty compelling. Let's break down the bull case, the core arguments for why people are so optimistic about 361. So the whole optimistic view really boils down to 4 key things. First, they run an asset-light model. They don't need a ton of expensive brick-and-mortar branches to grow. Second, their focus on wealthy clients just has better economics. Third, their revenue is nicely diversified. And finally, they have this incredibly powerful thing called operating leverage, which we're about to see in action. And this is what they mean by operating leverage. It's a beautiful thing, really. It just means that as their revenue goes up, their costs don't really go up at the same speed. So more of every new rupee they earn turns right into profit. Look at that. Their operating profit margin leaped from 39% to 54% in just 3 years. That's the power of a really scalable business. You know, this quote I saw on the Value Picker forum just nails it. You've got a rapidly growing pool of super rich clients in a market that still has tons of room to grow. That creates a perfect storm for a company like 361 that's already well positioned. And here's something that investors love to see. The company is all about sharing the wealth. They have an official policy to pay out at least 75% of their profits as dividends. That tells you they're not just focused on growth at all costs, they're also dedicated to rewarding the people who own their stock. Okay, but it can't all be sunshine and rainbows, right? Of course not. Every investment has risks, so let's flip the coin and look at the bear case. What are the things that could actually go wrong here? And the risks here, they kind of fall into 2 camps. You've got the internal stuff, the things they can control, and the stuff they can't. Internally, the biggest risk is all about people. This business is built on personal relationships. If their star managers leave, they could take billions in client assets with them. Externally, you've got the usual suspects: regulators changing the rules, a big market crash, or just a flood of new competitors. And another investor really hit the nail on the head with this one. In this business, your reputation is everything. Being able to keep your best advisors isn't just an HR issue, it is, as the quote says, a fundamental business risk. It's that serious. And man, they are not alone. This market is just too juicy, and the competition is piling in from every direction. You've got the huge private banks, other independent guys fighting for the exact same clients, and now this whole new wave of slick, low-cost fintech companies trying to completely upend the old model. All right, so we've got the bull case, the bear case. Let's try to bring it all home by looking at how they're actually doing right now and what their game plan is for navigating this tricky environment. First things first, let's talk valuation. How does it stack up? If you put it side by side with a competitor like Motilal Oswal, you'll see 361 has a lower price-to-earnings ratio, which could mean it's a bit cheaper relative to its profits. But at the same time, its return on equity, which is a huge measure of profitability, is higher. So you might be getting a more profitable company for a better price. And their performance right now, it's pretty darn strong. In their latest quarterly results, revenue just shot up by 28% compared to last year. So despite all the risks and the competition, the business is clearly firing on all cylinders. And here's the kicker. That growth is flowing right down to the bottom line. Net profit was also up by a solid 28%. This just proves that scalable, high-margin business model we were talking about earlier is working exactly as it should. So the big question is, how do they keep this engine running? Well, they've got a three-pronged strategy. 1, they're doubling down on digital to get more efficient. 2, they're looking to unlock global opportunities through their huge UBS partnership. And 3, they're actually broadening their target market a bit to go after that next tier of wealthy clients. And that really brings us to the final multi-crore question. 361 has a clear strategy, a dominant market position, and the powerful tailwind of India's growth story pushing it forward. But in a game where the stakes keep getting higher and more players are showing up, will its focused, high-end strategy be a winning fortress, or will it become a gilded cage? That is the question.